Good evening, everyone, and welcome to Thought Leadership Thursdays. It's great to have you with us when we dive into another session designed to help you make smarter, more confident investment decisions. If you're with us for the first time, Thought Leadership Thursdays are monthly sessions or articles that explore relevant topics that investors should know about. Our guest speakers provide real insights without any of the fluff. Our goal is to help you think calmly, clearly, and strategically. Our presenter tonight, as you know, is Andrew, who is Head of Product Structuring here at Cashbox Global. And Andrew has over 30 years' experience in international financial services, and since 2013 has maintained the stewardship and general counsel for his family office practice down in Cape Town. But before Andrew starts, let's start with some housekeeping, as always. To the next thing. So Cashbox Global is regulated in both Mauritius and in South Africa. Our full disclosure document is available on the website. Sorry, I've got dogs fighting here. Apologies. The webinar is education only and not financial advice or investment advice. Always make any decisions based on your own research and, if need be, the advice of licensed professionals of your choosing. Okay, so before we get into the detail, what we'd like to do is a quick poll in the chat. If you wouldn't mind dropping the number for your response, you can see the question is, what do you think the biggest risk is to your investments, possibly in 2026? And then the options are American deglobalization, AI, cyber risk, the US-China trade war, global interest rates and inflation levels, a widening war in Europe, US markets overvaluation, and then last but not least, a global market crash. So if you wouldn't mind just popping your number that you think in the chat. I already posted this poll on our community group earlier on today. The community group is a group where it's not a chat group. It's used for new products, invitations, webinars, and any other important updates in the market. Often Andrew will see something and in real time, he'll just post something onto that group, but it's definitely not a chat group. If you would like to join that group, you can just scan the QR code on the screen and it'll take you through and you can sign up to that. But if you wouldn't mind dropping your number into the chat so we can monitor it over there. Cool. So I'm going to give you 30 seconds to do that.
Yeah, it's interesting because we'll share that the results that the community came out with. It was quite overwhelming in terms of what their sentiment was, but it'll be interesting to see what a wider group come through with.
Interesting answers in the chat group, Andrew.
Yeah, okay. Maybe go to the next slide so long, Jill. We can, while people think about it, I can just do the intro. So yeah, this is our last actual webinar, Cashbox webinar for the year. I was trying to work out how many we've done this year, but I think it's been quite a lot, and it's one way of really staying in touch with on the pulse with our investors. So this is the final one for the year. I'm off for a bit of leave back early December. And I think it was we all agreed it was a topical subject of what can we expect next year. And I think the picture says it all. We've got a globe, and it's been a pretty rough, in some instances, type of year that we've had this year. And we've also called it reasons to be cautious. And I think some of the poll itself indicates that there's reason to be have a sage and cautious approach in terms of how do we look at 2026. I've probably spent the last 2 weeks, the better part of nearly, I think it's 7 webinars, 3 with American private banks, 2 in the UK, 2 Swiss, some big heavyweight data analytic teams like The Economists, Reuters, Barron's, some really big organizations. And there's been a mountain of information that I've had to sort of sift through and try and make sense to see, without giving advice, to see what have been the major drivers this year, and will they be around in 2026? And if not, what might be in their place? And are we going into a brighter future than we have this year? So I also realized as we were going through these, and some of these webinars lasted up to 2-3 hours by invitation only. It's such a massive topic, and I said to Jill earlier that some of the subtopics would form thought leadership discussions on by themselves. The likes of gold, crypto, oil, energy, etc. They're topics in themselves. But what we are trying to do, and what I'm hoping we're going to share tonight, is to help everybody navigate in this unstable world. So after wading through a ton of data and analytics, the next 45 minutes and questions answers is going to be centered around 4 major sort of modeling areas. So if we can move to that slide, Jill, if you may. So most of the webinars that I've attended have concentrated on 4 major areas of modeling. Country and industry analysis, which sort of speak for themselves, financial risks associated with that, and operational risks. So this is where the modeling came from. As we mentioned, there's going to be a period of questions and answers that you can pop them in at the end of the session. And so the agenda for today is essentially divided into 3 parts. And let's just go and have a look at those 3 parts. Okay. So the global economic outlook, how are we looking going into 2026? The geopolitical risk, which was a major driver this year in terms of the various hotspots and flashpoints that we had to face with and deal with during the course of 2025. And obviously the issues in focus are what drove the investment markets during this sort of period. I think before we go to the next slide, this is sort of part 1 now. It's really talking about, what is the consensus view, top-down view on the outlook for global growth, because that's what it's all about, global growth. Are we going to grow in 2026? So I think the headline story for the next year is that essentially, we're not out of the woods yet on quite a few fronts. Let me give you an example with the next slide of a sort of real in-your-face slap. Okay, so if we go to the next slide, kindly put together by Logan. Thanks very much for all the tech work you did behind. Right, so there you've got a slide of 7 indices, global indices: China, the United States, the Swiss, the 3 American markets, and the UK. So it's an overlay going back to January of this year and kind of where we are at the moment. And you can see that to a large degree, they all followed each other. Obviously there was divergence, but they all acted very, very similarly at one particular point, and that was April. And that's the in-your-face example. The world got tariffed in April 2025. And it sent seismic shockwaves through equity markets and through economies. Lots of noise and thunder, gnashing of teeth stuff. It really was. Markets felt like we were all the way back in March 2020. There was a feeling of panic and fear all over again. And yet, a fortnight later, most of those global equity indices began an unparalleled run up in valuation, as you can see to the right-hand side of that screen. So it shows you that despite a major, major wobble and a major shock to the global system, this year has actually been quite a good year if one looks at it in hindsight from January through to November the 14th, where we are at the moment. So let me show you another slide. This is another sort of in-your-face slap. 3 weeks ago, if we can move to the next slide, please, Joel. 3 weeks ago, there was a major investment conference held in Hong Kong. And the CEOs of JP Morgan and Morgan Stanley, Ted and Jamie, were on the same investment platform, speaker panel platform, and they endorsed the fact that they believe there would be a 15 to 20% pullback. Okay. But in a disorderly fashion. Now, isn't that a lovely word, disorderly fashion? Most pullbacks are normal, they're natural, and they can be quite healthy. It's where people might take profits. People take some money off the table. They've had a good run, they're reallocating, they're balancing their portfolio. Disorderly is the kind of word that gets in the way because it means that there's almost a panic and everybody's rushing for the doors. So to the one point on the poll is, do people expect a market crash? These 2 individuals said, yeah, there could be something of a cliff waiting out there for us. Essentially, and you saw what happened you wouldn't have seen on the previous slide, right, about 3 weeks ago, there was another dip down in those lines, in those charts. But again, a very, very quick recovery. But what happened there is, again, the noise that was generated at this conference, and the G20 waded in shortly thereafter by saying, yes, we absolutely agree the valuations of certain markets, okay, what they priced at, is out of kilter with what they're really worth. They're not true and fair value. And they didn't go as far, but they should have been just saying it's America, it's the US, which is overvalued and overstretched. But markets wobbled, black holes appeared, and they ate up market capitalization all over the place. And it all then recovered. It carried on. The last couple of days, we've been seeing the Dow, the S&P, the Nasdaq making new highs, irrespective of all the drama that's been going on in the United States of late. So it tells you a little bit something about the human narrative, that we have flaky memories, but we are resilient. And I think the world, like Atlas, shrugged, and on we went. Now, just as a counterpoint to these two individuals who are the leadership team of two of the biggest, most powerful investment banks, if not in the United States, in the world, the counterpoint to that is the next slide, which shows a little bit of counterbalance to the panic and the market crash scenario. He's getting a little bit older, like we all are, Bill Gates. But certainly, I think his perspective is particularly valuable in turbulent times. Short-term market swings can trigger panic, but long-term trends such as technological innovation, demographic shifts, economic growth, they tend to have a greater impact over the course of a decade or even longer. And often, you've heard me say, stay the course, stay fiscally disciplined. And so some of these short-term aberrations, like we saw in April, and more recently, 3 or 4 weeks ago, there was quick recovery. So had you followed the herd instinct, mass panic, and that's essentially what a crash is. It's panic in fast-forward mode, where nobody really thinks very carefully. So these short-term swings have been around, and more than likely you're going to see them again in 2026. This is not just confined to this year. It's part of our psyche. It's part of our nature. It's how we behave. So let's move to the next slide, if you will, Jill. The 4 most dangerous words in finance: consolidation, which would be the pullback, regular profit taking; correction, which is basically a 10 to 20% retracement of where the markets are. You then go to a bear market, which is an expanded, longer period of doom and gloom. And then we get our crash. We're all going to die and we're doomed. Okay? Those aren't the 4 most dangerous words that many of us might think. The 4 most dangerous words were coined by Templeton. And this time is going to be different. Well, this time it's different. We always say that. We had a bad experience, but this time it's different. Okay? Now, that in itself means that we are perhaps not heeding the lessons that we should be learning, that we're putting our head in the sand and saying, okay, I'm just going to tough it out. I'm going to be in the trenches or be on the sidelines. I'm just going to stay what I'm doing. Okay, this time it's different. Or I'm taking a completely different stance and going contrary to what I normally do. So is 2026 going to be the same? Or is it going to be different? So before we go into the next slide, which is really the sort of economic thing of how healthy is the world at the moment, I just want to give a little bit of a narrative to that framing of that context. What was 2025? 2025, there was so much disruption in 2025. There was a lot of shifting forecasts, and we got these really big policy shocks that were implemented perhaps more slowly, or had mitigating factors. It all started back in April, when we had Donald Trump come out onto the world stage and say, right, the world as we know it economically is going to be reset. I also think of, in a way, the AI boom, and we're going to address that in some detail, offset some of that hurt that we anticipated as we worked through some of these forecasts after April. So there've been really a lot of moving pictures in 2025 and some really unprecedented changes in world economics and trading, etc. And it's tempting to think that of late that we've turned the page, because tariffs seem to have been pushed into the background, particularly in the States where there's other issues to contemplate, which is a lot closer to home maybe on a day-to-day basis. And I'm talking about the recent shutdown and reopening yesterday of the federal government. But it's tempting to say we've turned the page, or that we will turn the page, and that the global economy will then move into a far more stable period. We'll just see firmer growth, et cetera, et cetera, et cetera. But I think because of these policy shocks that we've had to suck up, They have been gradually implemented. And I think because of that shift, or because of some of the mitigation factors where it was changed copious times, we're now seeing the impact gradually over a number of quarters over the course of 2025 and into 26, rather than a take it or leave it of April. So we've got used to this. It's become part of our psyche. But that has now framed what global growth is going to do. Okay, so let's have a look at the next slide. If you could move to that, please. Quick map of the world. There's nothing on it. That might seem a bit boring, but we're going to go around the world now. So let's see. What's going to be the meaning for the 8 billion souls who live on planet Earth? And I think overall, the view from all the consensus that I've listened to over the last 2 weeks of all these webinars is that the real global GDP, gross domestic product, how much we generate, how much we create, is going to be around about 2.4 for the whole universe. That's everybody combined, 2.4%, which is just marginally down from 2.5% in 2025. So overall, it seems like it's going to be much of a muchness, same old. But let's have a look at, those figures have to be looked at in context. 2025 and 2026 forecasts taken together are still the weakest returns since the pandemic in 2020. But there's a significant improvement in the forecast since April. That April seismic shock was massive. Many of us don't realize how massive it was, but everybody had to re-rate, rescale, and redefine where in fact growth was going to come from. As the world worked through, those initial, the broadside that the American administration had fired. So we're definitely not we're not going into a normal situation. Global growth should be higher. So it's not a place of normalcy that we're heading towards for the global economy. And it's probably rather going to be another year of gradual adaptation to some of those shocks that may come through. You'll see right at the end of this presentation, one thing that we always will have is surprises. Surprisingly, we will have more surprises. Unsurprisingly, we will have more surprises, should I say. Oh, I just lost my camera. Hold on a sec. Right. I'm back. Okay, so let's move around the world and see where's this growth coming from. I'm not an economist. I apologize to all the economists out there who might be looking at this and saying this is a very light version, but I've tried to keep it light so that we can get a snapshot in 45 minutes of actually where we were and what the health of our planet is. So if we conclude that the US is still the engine room of the world and the gearbox of the world, there's an estimation that there's going to be modest growth in the US of about 1.4% forecast, down from, 2025 was forecast at 1.7. But because of the latest interruption, the federal government, unemployment issues, a lot of statistics haven't been able to be produced. That 1.7 is a question mark. But clearly where we are going is lower down the scale from 2025. So growth is going to be a little bit more muted out of the US. That means the US is going to hit its low point, okay, during the forecast period of 2026. Okay, so if they're going down to 1.4, during that period, it's hitting its low point. So while it's below its potential, obviously, it's not a disastrous outcome. The American economy has proved during all this drama of tariffs, of prices, increases, et cetera, that they are resilient. Consumer spending is their sentiment is okay. And I think the functioning of the resumption of a functioning federal government will ease matters hugely. Let's move across to Europe then. Europe's going to remain slow. You can see, a 1.1 figure. I'm talking about Western Europe, really. I think the supply chain adjustments that they've had to make as the effect of tariffs were weighing in, despite stronger investments in infrastructure and in terms of defense, which we saw in 24 and 25. I think the ongoing posturing of Russia and the stagnating Ukrainian war on the Eastern Front has led to a more self-reliant, more self-driven Europe, which is probably a positive thing. And like in Asia, the Europeans were very clever in terms of they knew tariffs when they were coming, so they front-loaded all their exports. It's basically, they said, let's get things at a cheaper price, let's get them exported, and then we'll deal with tariffs as and when they come along in the 30% or whatever Europe was being promised. So they did pretty well in 25 because of that front loading of export. That's going to fade in 2026. And there's also going to be probably, and this is a fact of life probably, that there will be increased competition from China. So products and exports that would otherwise have maybe found their way to the United States are now going to be looking to settle in Western Europe, which obviously would further erode, manufacturing outputs of a fairly stagnant economic engine in Euroland and Eurozone. And yeah, those Chinese exports will compete with European exports, etc. So consensus view about 1.1%, down from 1.2 in 2025. So it hasn't changed a great deal. So again, no major changes anticipated in the consensus estimation. Let's go to the next one, which is quite interesting. I've used India as a proxy for the emerging market groupings. India is probably is a bright spot. Well, the emerging markets are a bright spot, Africa as well, parts of Africa, and certainly India. It's quite politically challenging in terms of its ties with Russia and the pressure that the United States is bringing, but they've got a fairly healthy, the emerging markets, and I've used India as a proxy, as a fairly, fairly strong 3.7% there. Let's have a look at China and maybe just pause on China for a second. It's going to be a pivotal year as China enters a phase of fairly fragile stability with the US. The so-called one-year trade truce from the recent bilateral meeting that happened. It's also launching its it has a famous series of 5-year plans. And in 2026, it launches its 2026-2030 5-year plan. It's dealing with a massive property hangover, an infrastructure boom that pretty much collapsed on itself. And that decline will probably be evident right through 2026 into 27. And with shockwaves still have a very, very, very big effect on Chinese household wealth. Anybody who goes to China will see these vast tracts of development, which has just sort of been left as if everybody's just left the planet, half finished, half built. So big effect on China. We're going to deal with it in a little bit more detail in terms of its global political sort of aspirations. But the Chinese panda bear, if I can call him that, plays this double hand. Not just the economic arm wrestle that it will have with the United States in terms of rare earth minerals and all sorts of other soya beans and all sorts of other interesting things, or the US counterparts, but also on the geopolitical front, which is we're going to transition into that next, which is the second part of the presentation. And I think we've got a slide on some of the flashpoints that we've got around the world that continuously fueling worry, for the world as we go around it. So I've broken this up into a number of different buckets, if you can call it that. The buckets are existing hot points, existing areas where we've got issues, and I've broken them down as sort of, those existing areas of conflict that have quietened down of late, but obviously flare-ups can happen on the cards at any moment. I'll probably think, the Palestinian Authority, Gaza, Israel, Iran. That was very much a very big deal in terms of spreading into a much wider regional conflict earlier this year. And weighed heavily on things like oil, on gold, on markets, etc. That seems to have quietened down a little bit. Obviously, there's ongoing areas, like the Ukraine, which is just stagnating and simmering. We've got the North Korean situation down in the Asian area, which is constantly, North and South Korea, they're constantly testing weapons. There's constantly issues around Taiwan. There's a lot of maneuvering going on there, and it's quite a scary situation there, because everybody felt that, well, if while everybody's keeping their eyes on the Middle East, maybe China would just go marching into Taiwan. It didn't happen, but there was heightened risk over that period for that area. And then there's a new buckets of sort of potential conflict being exposed, sort of the soft underbelly of Euroland, Western Europe, Poland specifically, the Baltic countries, I think, given their close proximity to Russia, and more recently, quite an unusual one of Venezuela on the sort of the top bulge of South America. We've seen some dramatic footage of US guided weapon strikes on these sort of so-called drug running boats. and more covert intent regarding the incumbent government. And that's really what it's all about, I think, politically. The USS Gerald Ford, the largest aircraft carrier in the world, has recently moved in. I don't think there's going to be an invasion, but we don't know what might happen in terms of the actual political incumbency of Nicolas Maduro, who runs the show there. Not on Donald's Christmas card list. So these are all areas that we'll need to be watching next year. The Sudan as well, in Africa. That's a tragic story unfolding in terms of genocide, in terms of people just being killed out of hand between warring factions, the government, etc. So tragic situations around the world, but these bring to bear, this geopolitical risk. And geopolitical risk was a big feature of all the webinars that I've spoken to, and they certainly believe it's episodic that will test us during 2026 as and when they flare up, which they more than likely have been estimated by consensus that this will happen. So these are things to watch in the coming year. I think let's move on to the US-China situation, because in the next slide, please. This is really it's been talked about for, Jill, if we can move on to the next slide. Or Logan.
My computer's doing some interesting things. I don't know why it's not moving.
Okay. Well, let me, while you figure that one out.
There we go.
There we go. Yeah. So, yeah, obviously center stage, while, if we can go back to that slide of.
I don't know, my computer's doing the weirdest things.
Yeah, that one. No, one before. You got a sneak preview of everybody.
There, I don't know, my computer's doing strange things this evening.
Okay. Yeah, so China and the US, their tariff trade talks had to come to a head at some point. They were the proverbial elephant in the room, just to mix up animals into the bald eagle and the Chinese dragon there. But US-China rivalry has been talked of for years and years, and now it's pretty much a fixture on any risk map that you look at. But 2025 saw some significant movements with tension ratcheting up and then down and then up again. And, we currently have a tariff pause over the last, resulting from the last bilateral meeting. So what can we expect in 2026 from these two? So can we unpick anything from 2025's behavior? So it's been a bit of a roller coaster, what I can establish. There's been so much volatility in the headlines. It's a little hard to unpick what the major trend is. And without being too sanguine about it, US-China rivalry is not going to go away. And it's going to be a defining theme of not just next year, but of the coming years as well. And I think that subtitle there, the economies will continue to splinter. The world is seeking new counterparties, new partnership deals. People are starting to form alignments. The world is changing in terms of its polarity and who gets on with who. But certainly it's felt that we may have more stability during this truce period going into 2026. It's felt that neither the US nor China really want to escalate, particularly the economic war. It'll probably simmer, and we're probably going to have to look to other parts of the world for that rivalry maybe playing out. Some examples, I mentioned rare earth minerals just now. So maybe critical mineral supplies will bring in countries like Australia and Malaysia into focus. And for instance, as I mentioned, Venezuela and South America, in terms of political elections that are happening and governments that are aligning themselves to China or the States. Africa as well. There's going to be a battle for the control of influence and the resources of Africa. Taiwan, is a seminal example of, it's got the US as its protector, but China regards it as, just an errant child that's left the cot and needs to come back into the crib shortly, even though it's been independent for many, many years. So there's a lot of risk around the world, and it can escalate so quickly, either by an intentional act or maybe unintentional act. Earlier this year, we had undersea cables being cut. We had gas lines being blown up. Was that a mistake? Was it an accident? Was it caused? Was it man-made, etc.? So all these ratchet up the tension levels. So that's pretty depressing, but it's part and parcel. It's not going away. And I think let's just deal and close off this depressing part of the presentation with maybe the Ukraine. which is also a very unhappy stage of its development. We don't, if you can move to that next slide, we don't expect, or it's not expected, that there's going to be an unblocking of the situation in the near term. And the continued Russian, we see it on TV every day, the continued Russian strikes on Ukrainian energy and infrastructure, especially transport infrastructure, is driving a lot of inflation and energy insecurity, specifically in Western Europe. Okay, hence those Baltic states, Poland, and the like are very concerned, and even further afield, Western Europe, the UK, etc. And this probably remains the biggest single threat to Western Europe, that the conflict actually does spread, it does get wider. And there's the additional fear that the United States might not be the army of last resort to help NATO if this does happen. So there's a lot going on there. Recently, US sanctions, new US sanctions came up on the two largest Russian oil companies. And that will certainly heighten financial insecurity and certainly financial strain for both the supplier and people taking on Russian oil. The Russians have, however, become very adept at adapting to sanctions. They have shadow fleets. They have all sorts of interesting things in terms of getting their product out and being paid to fuel their war machine. And that's really been, I guess, as an example, a theme of 2025. Trade diversification or diversion, finding new partners. If we can't export there, we'll find somebody new who wants our product, and we're not going to pay 30% or 40%. So that's been a major theme. Diversification and diversion of your exports. Russia's been hit by it left, right, and center, but 3 years into the conflict, they still fuel their war machine. I think the ultimate expectation, and probably the most lucid comment I had on this, was from the chief investment officer of Rothschild's Bank in London, who suggested that the ultimate expectation of the conflict is probably going to be a weak peace deal next year. Okay, with the freezing maybe of the current geographical positions, and it's certainly going to be very flimsy for the Ukrainians than for Russia, as the whole conflict, I mean, the war's happening on their land anyway, and the whole conflict could reignite at any moment, and certainly within the next few years if the status remains the same. So it's very much on pause, but it's not helping the situation. Okay, so let's move into perhaps the area that a lot of people are really interested about, because these were drivers that really pushed sentiment. Now, what powered the markets in 2025, and is it going to be a factor in 2026? So we want to move away from geopolitical risk and talk about the big trends that are going to affect every single country in the world. And that means we have to talk trade, and we have to talk tariffs, and we have to talk AI. So those are the real big areas around where the next sort of 15 minutes will be. And how is this dynamic going to evolve in 2026? So, well, the buzzword in 2025 was tariffs. I mean, you've all heard it, we've all heard it. And give or take developments, that's going to evolve in 2026. They're here to stay. Tariffs aren't going to go away. As Donald elucidly on the Rose Garden, all of the Rose Garden at the White House back in April said, get used to them. And in as much as we can't, as I mentioned, we can't turn the page on tariffs yet. Essentially now we're looking at a more settled landscape of tariffs. People have got sort of used to it, that they're going to have to pay something. But it's interesting that not only are they're sort of largely in place, but some haven't even been written down, let alone signed, which is quite interesting. But I think essentially political and economic pressure will basically keep the US will keep them in place. I mean, there's a Supreme Court ruling that's going to emanate in mid-2026, in time for the midterm elections, which may well strike down these tariffs as an unconstitutional implementation of legislation to circumvent Congress. Congress is supposed to make the laws. So what Donald Trump has been using as executive orders is a way of getting around in emergencies, what he believes is an emergency, to getting his type of legislation put in place. But I think it's felt that even if the judiciary does strike them down, the US Hawaii court strikes them down, the administration will, reconstruct them via some other mechanisms. So companies had better accept these costs. If you're a businessman, if you're a CEO, if you're working out your margins for 2026, accept that they are part of your input costs and they need to be factored in. So yeah, let's have a look at what powered. That was the big driver. So what really powered the markets up? What gave them this huge, dramatic input? So this is an interesting slide, and thanks again, Logan, our tech guru. This is, this is why money makes the world go round. The red line is corporation tax in the United States of America. It goes up and down. It's been dipping off a little bit late, and it goes back to 2010. And look what happened in mid-25, early 25, April. The first tariffs came in, and look at that blue line at the bottom. It goes exponential. So logic says that fiscal revenue, the receipts that the federal government is receiving from import duties and taxes being applied to product coming into the United States, is now becoming quite a serious part of the revenue receipts of the US government. Okay. So it's going to make them difficult to undo. They far outstrip at the moment corporation tax, on a periodic basis. And they roughly amount to about, 7% of federal receipts. So it doesn't quite balance the budget, but it's certainly an important component of government cash flow. And in real terms, the current effective rate is about 6 times higher than it was prior to 2025, when it was implemented. So a very big shot to the global economy. And the full effects, we haven't seen all of them yet. They're starting to come out. They're starting to materialize over quarters and sessions and semi-annual periods. So if tariffs became the headwind, okay, for us, for the government, it's a great boon of income. But for us, we're now having to pay more for our product, whether it's off the shelf, whether it's an import, export, whatever. So where's the tailwind that made the markets grow? Because this didn't make the markets grow. This is a big constraint. So if we go to the next slide, we have this thing called the AI phenomenon. Okay, here we go. Okay, thanks, Jill. I mean, I wasn't responsible for any of these graphics or pictures or putting it together. I'm just the voice. So thank you both again for a lot of work and me jiggling things around. So yeah, AI, it's increasingly dominating every market discussion. Certainly in the last 6 months, AI investing is interesting, as it's actually been going on since about 2022, where it really started. And we're starting now to feel the GDP benefits of AI-related investments. And it's this year, 2025, where we really started to feel this benefit coming through by driving equity wealth as other investments dragged. Okay, and consumer consumption was slowing down. So what I'm meaning by that is that people who are investing into AI-styled investments or linked to AI started making money out of them in the market. Okay, and it started replacing other type of income investments, other type of asset allocations. So it suddenly became this whole theme of itself, and you've seen this rolled out by all the investment banks. It's been a popular theme. It's been the theme of the moment, and I think, as I mentioned earlier, the G20 came out 3 or 4 weeks ago saying US valuations were a little bit stretched. And I said they missed out by saying US. I think they also missed out by saying the particular sector in tech is overstretched and overvalued. They didn't say that either. And if you think about it, I mean, looking at US markets currently, the stock market is almost entirely driven by AI stocks and growth in those companies that have literally, pushed this AI into, the front of the starting blocks. The combined value of what they call the hyperscalers, the combined value of those hyperscalers is dominating the S&P and the NASDAQ. So when you have a twitch in one of those companies, you're going to have an exaggerated stretch to make the twitch go away. So all I'm saying is that the concentration of wealth and where the drive is coming from in a very small sector is overwhelmingly held by a very small number of companies. Take you back to 2020, the rebound from COVID. was started by tech, when all those things that were digital and in the futuristic suddenly became our daily tools of doing trade and doing business and interacting with fellow souls. It was constrained to the tech area, and very similarly, we've got this concentration in a very narrow area, which is dragging the rest of the market along with it. It's very contentious because the wealth effect in the US at the moment is actually an AI effect. It's been caused by the investment and the wealth and the valuations of these AI-style companies and companies investing in AI, the hyperscalers. And unfortunately, it's sort of unequally distributed across the population. Not everybody gets to benefit from it. If you're not in the stock market, you're not trading, you don't always see that benefit. But that equity growth has fueled and supported private consumption, which has dropped a little bit. So the big question, and it was one of our poll questions, is this a bubble? If I'm saying this is concentration and it's very focused and very defined, is it a bubble that we should be concerned that may actually cause a crash? And that's, again, one of the points that you could have clicked on for the poll. And I think Jill found a nice balloon with a pinprick about to pop the bubble. So I think the best way that, whilst you read ahead, the best way I can describe it is I think the biggest comparison that have been made to, is this a boom or is it a bubble, is that comparisons have been made to the dot-com bubble of 2000. We all remember that. It's only 25 years ago, but yeah, we were all probably around at that stage. And at the moment, some of those exponential charts are tracking very, very similarly. AI investment is approaching historic proportions in terms of the money that's being poured into these companies. And a bust would dwarf the dot-com bubble. It really would. It's the monies are much bigger. But there's some very, very big differences in terms of what happened then and what we're talking of now. And I think these so-called hyperscalers, the Metas, the Googles, the Amazons, et cetera, et cetera, et cetera. These are companies that are playing huge swathes of investment into the sector. And they're doing it on the basis that they're going to capture economic returns in the future and provide suitable return on investment to shareholders. I mean, that's what shareholders require. And you're going to have to capture that economic profit down the line. And so it's all about, we're going to be showing returns at some point in the future. But now if that doesn't happen, or if these hyperscalers end up competing so fiercely against one another that none make extraordinary profits, that green light that we're being shown to the stock market now may actually turn amber. It might actually even turn red. What would the effect of that be? And I think the difference being is that we're not going to go to an amber or a red. The difference being to the dot-com bubble is that these are companies, on the positive side, these are companies that are not revenueless. These are companies with extremely large, massive revenue balance sheets, lots of free cash flow in their valuations and in their war chests. So, these companies these hyperscalers would be hard-pressed to fall to zero in their valuations. That being said, there are more people now globally who have got wealth in global equity exposures, more so than they were perhaps in 2000. So meaning that household wealth now, your and my household wealth is probably closer tied to this AI boom that's going on. So if there was a big fall, it would have a very big effect on the global economy. So the little word called diversification springs to mind. Okay, it's something quite useful to actually just keep going. I was really lucky to listen to a private interview that hasn't gone live with Jensen Huang, who's the CEO of NVIDIA. And he's a true believer in AI. These are the true zealots, if I can call it that. He really burns as a zealot in terms of AI. And part of the download that was supplied to me is that he is less concerned with corporate productivity, as nice as that would be. His optimism is based on a far grander vision, which is very interesting. He regards as this is the most important human invention in all time. Okay, it's sort of no less than the the birth of a knowledge machine, and in time, a wisdom machine. And there could be no price on it. There's no upper bound to spending. So it's seen that way. It's an investment in prosperity. It's not a speculative sort of folly. So my synthesis of listening to somebody like him and listening to the pessimists is that the question is, are we in a bubble? My own personal view after listening to hours and hours of people, very clever and bright people, is that we probably are, okay? But that isn't necessarily a condemnation. Bubbles, I think, are often, and in my last week's wrap, I actually mentioned something about bubbles. Bubbles are often what it looks like when humanity prepares for a new change. When it was the invention of the motor car, the internet, maybe AI. And it's the capital markets, it's the investment world that says, hang on, we're not sure if this is actually a bubble or not, okay? But let's do it anyway, okay? And if AI fulfills half its promise, even if it just finds a cure for cancer, for example, future generations will probably thank the developers of AI for where we got. If it doesn't, then we're probably going to have plenty of processing units and fancy data centers and nuclear fuel power stations littered all over the world, but we can use that for other stuff. It'll probably be the world's most expensive reminder that innovation rarely moves in a straight, sensible line. So that's the AI. It's not going away. It's part of us. Valuations are stretched, and we'll deal with that in the last slide now. So, yeah, there aren't any surprises. That a surprise is coming. Can we go to that last slide then, Jill? Please. Yeah, there we go. So it says it's for itself. Something's always factored in that's going to be unexpected. And hence, therein lies the surprise. You'll see the second point there is the concern. That's the bubble concern about sky-high technology share prices, the very narrow area of the market that's driving growth, stretched corporate valuation, the companies that underpin that sector, and obviously leveraged retail investors. The United States investor is seriously leveraged at the moment. I heard a report this afternoon that 1 in 4 families is now living paycheck to paycheck. A lot of people might not be paid for the 43 days they were off work. Some might not even be going back to work. It's pretty tricky. You're talking about 1.5 million people. We've got an unpredictable US president. So there's a dangerous cocktail. Reasons to be cautious. So, in conclusion, my conclusion is that we live in an unpredictable world of occurrences, man-made or otherwise. And these are points either planned or when required that we need to rein in our views and reflect quietly. And they should reflect both the short-term tactically as well as the long-term strategically, in your plans, your investment plans. And adaptation can be expensive. To Bill Gates's point, maybe stay the long term, or maybe get out if you're a short-term, investor. So buying too late and selling too early, we've all heard that can be expensive. And a plan always has a beginning and it always has an end, but it's got to be constantly tweaked. You can't start a plan, put it in a drawer, and look at it every now and again. You're constantly changing it, tweaking it. And to my point, you've got to stay diversified. You've got to ask questions, never stop learning, and stay informed. It's your plan that must resonate with your requirements as they change, and not so much of what comes out of the noisy equity market mill. And that's pretty much the sort of forecast for 2026. What we were not allowed to do, and I took advice on this, was to say, oh, we believe this sector is going to fire and that sector is not going to fire, and you should be going light on this sector and that sector, because Cashbox is not an advisory company. So this is more a broad brushstroke, holistic look at what has driven the world and what's probably going to be in place next year. These are the major trends, the major themes. Now, Cashbox's own way of doing things is that when we launch notes, you'll have seen a very strong thematic alignment with themes that we feel are prevalent and that have a longevity past sort of 2, 3, 4 years in terms of the net length of the note. A lot of work goes into that thinking, and we certainly believe that as we go into 2026, that thematically we will resonate with those challenges and those surprises that are coming up. So that's it from my side. I'd like to thank sort of Jill and Logan for the work that they've put into this. I'd like to also thank for the remainder of the previous 11 months, the support we've received from our structures, and Graham's on the call. Many of you have heard him. Thank you very much for your assistance and help. And we hope to really surprise on the upside in early January with a note that I'm starting to look at and work on. We've had a really good run of auto calls of late. I know a lot of clients are sitting on their hands in terms of waiting. So hopefully we will have something to show you and share with you and invest in before the end of January in 2026. Jill, I don't know, is there anything in the poll that we could share or discuss?
Yeah. So thanks for that, Andrew. I think before we head to, well, first of all, should we head to the poll first? Chad's got the results of the polls, and then we need to open for questions.
Cool. So from online, there was a nice mix, and I think your questions were good ones. 3 got voted twice, 4 got a vote.
Okay, can we just what those actually were? I'll tell you now. Give me 1 second.
I'll give you the top 2.
Hang on a second. I just need to get into the poll. So 2 was AR cyber risk.
Yeah. And then the second, this jumped to 7 votes, was number 7, the last one.
That's a global market crash.
Yes, and then overwhelming, the one before, the overvaluation, I think.
Was that the highest? Was US market overvaluation?
Yeah.
Okay, interesting.
I think, thanks, Andrew. You addressed a lot of these. Always interesting to listen to your chat. Thank you.
Yeah, there's while I'm away, I've prepared for the weekly wrap. Hopefully you're getting it. Those 4 scary words, which are scary, maybe not the scariest, but they are scary: correction, consolidation, correction, bear market, and crash. I took a bit of a light-hearted approach to it, so in advance, please don't get cross. But it just shows you how, as humans, we all approach different results and outcomes from a different viewpoint. So that won't be coming out this weekend. It'll be coming out the following weekend, but keep an eye out for that, because we've spoken about a crash. It's obviously high up on the ladder there in terms of what it is. And I think my best definition for a stock market crash is, as I said, it's panic and fast forward. It's violent, it's brutal, it's a sudden drop over just a few hours or a few sessions. It's got nothing to do with anything orderly. That's why I got a bit concerned about Diamond and Pick's disorderly word. And there's widespread panic. It's not the scale of the decline, but it's the speed and the severity and the violence of it. And I certainly hope that we don't have that. The optimist's view of a crash is that there's an end to everything. And as I mentioned, I think the pessimist's view is that we're doomed and we're all going to die. The graphic representation was a little bit like April this year on that chart you saw with those 7 indices. It looks a little bit like a cliff. You fall off the edge of a cliff. You go down a mine shaft. We saw that in 2020. But I think the best quote I had the best quote of somebody who'd been through a crash was that I'm not broke. I'm just in a phase of post-traumatic tax optimization, which means you got no money. So we don't want to get there. And diversification, again, that's a whole topic on itself. If there's diversification in a portfolio, if you're watching your investments and you're getting informed, you're asking questions, learning, that is one of the best antidotes to panic that sets in.
Yeah. Andrew,
Chairman says, will we find gold in the mine shaft?
Exactly.
And that reminds me, one of the the biggest standouts, I think, so far this year has been the price of gold, right?
Yeah.
And maybe that's, you know, against the S&P. It was very interesting. I got to see a graph, instead of S&P to the dollar, but the S&P to gold, or gold to the S&P, and how gold outstripped the S&P this year, which is a standout, right?
Yeah, absolutely. Yeah, look, I mean, gold, I think that has to have something to do with the geopolitical dramas that we were going through worldwide. Many central banks globally are stocking up on gold. I'm not to say that I don't think there's a de-dollarization, but the dollar has certainly lost its luster in terms of it's the major currency of the world. But generally, in times of turbulence, gold has always been a safe haven. It's been the tangible gold, and obviously companies that mine it or explore for it or etc. They've done very well. If you look at the mining sector, and that's probably, I mean, if you look at the consensus, I'm certainly following it quite closely at the moment. If you look at the consensus for where gold might go, that was 2025, Chad, but where might it go in 2026? Goldman Sachs is talking 6,000. And they've got reams and reams of paperwork to back it up and very clever analysts. But will it get there? It's taken a bit of a pause. I think it's done a 4.3 at the moment, 4,250, should I say. So it's done exponentially well. But again, it's a diversity issue that one must think about. Whether you hold golds, whether you hold gold mining stocks, whether you hold an ETF. Again, it's a diversification according to what your requirements and what you are looking to do for yourself or your family. Yeah.
Wonderful. So are there any questions burning questions? We've got a few comments in the comments, but not a question yet. I think you're getting really good at this. Shemin has raised his hand. Shemin, speak to us. You're on mute.
Her hand.
Her hand. Sorry.
So this is like a layperson thought and question, Andrew. How is Europe going to fare based on the fact that they have caused so much issues with the nuclear mine, the nuclear power, all the other kind of power? It seems as though they don't have enough energy that was cheap before to be able to grow their manufacturing base. I was hearing the other day that they're looking into going into war, but creating their own steel and building their weapons because Trump is not giving them those. And I'm thinking, but where's the energy coming from to do that? And how would Europe be impacted in this next few years with what actions they've taken since the lockdowns?
No, so it's a very complicated, interweaved situation. So the question is, it's a broad question, and as I mentioned, Europe has become a lot more inward-looking, a lot more self-sufficient. They've had to realize that their contribution, for example, to NATO has to step up. Because the Americans might not come in. They might not see Western Europe as strategically important anymore, or the UK for that matter. So there's been a lot of infrastructural spend. But again, the Western Europe, it goes more not just to economics. It also goes to cultural, softer cultural issues, which actually are very hard. Western Europe over the last 30 to 40 years, even longer, since the end of World War II or the Cold War, have become, I won't say liberal, but Western Europe has become, shall we say, soft, okay, in terms of how it saw perhaps Russia. There was Eastern Europe and Western Europe. Western Europe was seen as liberal. It was seen as decadent. It did its thing, wada. Okay. The people have to change their opinion in terms of, well, if we get invaded, are we just going to roll over and become another suburb of Moscow, or are we going to fight back? Now, I think one of the most surprising features is the fact that Ukraine has stopped the Russian bear in its tracks for 3 years. It hasn't gone very far, okay? Yes, there is obviously the threat that if it pushes too far, it will escalate everything, but it's lost close to 1 million men. Russia's lost close to 1 million men killed or wounded. So Putin is certainly not going to go back and say, well, let's just call it off now. I've achieved nothing. So that war is going to carry on. Western Europe has issues with energy, for example, because it had lost its sovereignty to a large degree by taking Russian, liquefied natural gas from the gas lines from Russia. It's one of their biggest exports. So that's been switched off. So they've had to look elsewhere. Sometimes those processes of securing energy are more expensive. So if you look at renewable energy, for example, if you look at solar, wind, turbines, that sort of thing, it's still quite expensive to produce versus just turning on a gas tank in your kitchen or your heating or whatever. Western Europe also, their war chest is empty. They've donated and given away just about everything to Ukraine, so they have to basically rearm the cupboard. That in itself is an opportunity for business in terms of if you're investing in the right companies and those companies are getting government contracts and being paid for it, profits are going to go through to the balance sheet for ordnance that's being supplied to the armed forces. We saw last year and this year, Volkswagen, for example, has taken some of its unproductive car plants out of mothballs and has got a joint venture with a company called Rheinmetall, who basically build tanks and supply guns and weapons. And they've turned those production lines into armaments factories now. So it's a joint venture with Volkswagen. So there's a way of compromise and there's a way of doing things, but it's going to take time. And you saw the figure of the GDP of Western Europe. I can break down and say what Germany's is, but I mean, you're looking at 1.1%. It's slow, it's stagnant. That's what happened this year, and there's nothing much going to be 1.2 this year, 1.1 next year. Nothing much is happening there. Germany is the engine room of Euroland. And, they've had a new government. They've got all sorts of things going on there as well. It's not an easy situation being in the EU to say, right, well, we're just going to kick things into shape and off we go. They've got all these partners that they have to consider now, 27 partners before they go off and do something. So Europe is, there are going to be hotspots of investment opportunity. But I think certainly one of the themes that came through in the webinars I attended was a lot of those Chinese exports that would have gone maybe to Western Europe or to the US will end up in Europe. And as you say, it'll dent the manufacturing output of industrialization, let's say. It's no secret. I've got friends who live just outside of Düsseldorf and in Berlin. They said you can buy a really good Chinese electric car and you can't, with all the bells and whistles, and you can hardly buy a VW Polo with the same amount of money. So, they're dumping at the moment, and that can put people out of business and businesses out of business. So yeah, there's a whole debate, is American protectionism good for America? Well, time will tell. We've got people on the webinar tonight who live in the States who see it on a far more real basis, real-time basis of are tariffs going to help them? Or are they not going to help them? Recently we did a structured note on that theme where maybe at the end of the day, luxuries might not be such a component of your shopping basket, and we're going to need essentials. So we started looking at consumer staples. So if we find an opportunity in Europe and it makes sense, we'll certainly look at it. For example, that one company is a German-based company in that defense sector, Rheinmetall. We included in one of our notes. So we'll thematically find companies that make sense, but they need to have good balance sheets, strong leadership, good history, etc. And that's where we work closely with our structures who negotiate with the investment banks to make sure that we get the right companies included and the right themes ticked off. So that's a theme on itself. We could do a thought leadership just on that.
Time tells all stories.
Thanks, Simon.
Excellent. Great. Well, if there are no other questions, we will have the recording available early next week. It'll come out. And if you do have any other questions that come up overnight, if you wake up at 2 a.m. and I should have asked this question, drop us an email and we will get it answered for you, probably when Andrew gets back. but we've still got tomorrow. So if you get it in
Well,
early, we can ask Andrew to respond to your questions.
So, Jill, if somebody has a question at 2, don't you want to just put your telephone number in the chat?
Sure, no problem.
I was just thinking that actually.
I love you guys, but not that much. Talk shortly.
Thanks, everyone.
Thank you.
Thank
Keep
you.
well.
Thank
Bye.
you.
Bye.
Bye.
Thank you.
Bye.